And welcome to the Ramp Up to Retirement podcast with your host, Dan Reese. Dan, good to see you.
Yeah, great to see you. Beautiful, beautiful day here in Michigan. So that's awesome.
Oh, I know. The weather has been absolutely great. Although it's been bizarre, the weather has been super changeable where I live. It has been either raining and windy and just nuts or absolutely freaking beautiful. And we are in the middle of a beautiful phase right now. So that is a welcome thing. And speaking of welcome things, this conversation that you have today is actually really interesting because it's about Roths. And to put it in some context, things have changed in the way that you think we should be taking a look at Roths. So please explain.
Yeah, I think Roth conversions, which kind of we talk about quite a bit on the show, one of the things that was really driving those for the last several years was this idea that the tax rates were going to sunset. If you remember, like in Trump's original term, all the brackets kind of came down, which was a really good thing for pretty much everybody. I mean, we ran tax analysis for all kinds of clients at different income levels, and it definitely helped pretty much everyone. But the idea was those were going to end right at the end of 2025. And so a lot of people were kind of like, hey, your brackets are going to go up. Let's lock in some of these lower rates through Roth conversion. So we're going to pay our tax today. And then that money will be in a tax-free bucket in a Roth account. And it can grow that way, for the future, which was sound advice. But then, the new tax law came along recently that locked in those rates, right? So that actually is not a driving force anymore for Roth conversions because for now, anyway, those rates are going to be pretty stable.
Yeah, exactly. The equation has changed. And like so many things, I'm just going to say this right up at the front of this conversation. This is a general conversation. And for those of you who find this topic interesting, Dan and I would encourage you to sit down and talk with your financial advisor because details matter.
Oh, yeah.
All right. And I, of course, am going to encourage you to talk to Dan.
Yeah.
So walk us through this stuff, Dan.
Yeah, I think one thing to mention is, so we talk a lot about our 3-lane highway from a planning perspective. So you have the investment lane, investment management, kind of have your retirement income planning lane, and then you have your tax lane, right? And the reason this topic is so fascinating is because it really affects all three of those lanes, right? And so, we talk to people all the time, really the optimal time to really start doing really good retirement planning is 5 to 7 years out from retirement. And so as we talk through these things today, keep that in mind. Keep in mind that 3-lane highway. Keep in mind that 5 to 7 years out from retirement. But as we talk about Roth conversions, this also really applies if you are in that phase of life where you've retired maybe, but you're before age 73, 74, depending on your age for required minimum distributions, because all that kind of comes into play. And so I love this topic because, again, it definitely covers all 3 lanes of planning. And really, you can really benefit from these ideas at many different ages. So it's kind of cool as we dig into this stuff.
Yeah, so we know that changes have happened. We know that the One Big Beautiful Bill introduced some big changes. So, the first question that does come to my mind is, do Roth conversions still make sense at this particular point?
Yeah, I would tell you that Roth conversions, when done properly, which we're going to talk a little bit about that today. And I like what you said, because listen, this is complex. This is not something to run out and do without talking to a qualified, really, I prefer a certified financial planner as well as a CPA working together to verify that the things you're doing are really in your best interest, because there are a lot of moving parts, but they can be extremely powerful. For people, and really it can affect your own tax bill throughout retirement, and it can really affect your heirs, which we're going to get into talk a little bit about that stuff today too. But really, it's not so much about beating a deadline now, because that's really what people were pushing before. It's more now about really kind of managing the numbers for your specific situation, because now we don't have, it's always better when you don't have a deadline, but that can be a negative too, because you know what happens? People procrastinate.
Oh, yeah.
So deadlines can help because it gets people to move.
Well, deadlines focus the mind, Dan.
They focus the mind.
Do focus the mind.
all the way back from term papers in college where somehow you can get a whole lot done in a short period of time. But yeah, so they still make a lot of sense, but it's like making sure you understand why you're doing them. What are the real reasons that you're doing them versus just trying to maybe beat a deadline that's coming up.
So how much, is there a formula here that people can look at and kind of apply, or how do you know how much, if any, to convert?
Yeah. And this is where really planning comes into play, because one of the challenges that we have when you talk about all these things is all the moving parts across the 3-lane highway, right? And so, people ask, should I convert? Should I not convert? How much should I convert? All those types of things. And so one of the things that we always talk about is, and we start off with this with all of our clients, let's see what your current reality is. And what I mean by that is let's get all your resources in, your income needs, all those things in a financial plan that we can track. And there's all kinds of really good software out there that we use and that's available. But the reality is like getting it all organized so you can see what does your situation look like? Meaning if you do nothing, we always start out with, what if we do nothing? What is it really going to look like? And so the thing is, Roth conversions really to a great degree is a tax and estate planning play. And so what we want to know is like, if we do nothing, what will our tax picture look like over not just this year and next year, but over the rest of our retirement, right? And then what will our estate plan look like at the end of life, with the assets we currently have and how they're positioned, right? And so that's the number one thing, is to see what your current reality is. And then the second part of it is like, and I think visually it's the easiest thing because we show clients these things all the time. And I think, there are certain people that can look at an Excel spreadsheet and be like, oh yeah, I get it. And those are typically engineers and people that, they look at those all day long and they're like, yeah. Most people we find can be educated much easier through graphs, and pictures of things, right? And so what you'll see oftentimes on most people's retirement plan is that they have this low number of years that's low in taxes paid. It's like, hey, these next few years, this is great. We're not going to have any taxes, but we all know the taxes will come due at some point. But you look at the graph a little further out and you're like, whoa, why are our taxes going up so much down there, right? And so what we call that is the trough, if that's kind of a good term, right? It's this trough, meaning that we have this time frame where there really are very low taxes. But then when you have the trough, just like a lot of things in life, if you pay nothing now or pay very little now, oftentimes later on, there's a pretty big price tag, right?
Yes. So a lot of questions come to my mind in terms of the conversion, not only in terms of timing, but does it matter if you take out a whole lot in a year? You decide I'm going to do this and you just take a bunch out, or is it better I suspect it's probably better to spread it out, but I don't know. It probably depends.
Yeah, it does depend. And there are times where we've had people say, hey, I'm going to do a massive conversion this year, right? And because even though they get into higher tax brackets, there's a legitimate reason for their case to do that, right? And what that is when you run the scenarios, which you've probably heard me talk a little bit about scenario planning, which is kind of like, let's look at these scenarios. Let's look if we do it all at once. Let's look if we spread it out over years. What is the end result, right? But the one thing you always have to be aware of, if you do a big one at one time, if you are 63 or older, right, there's a good chance that that's going to affect what's called IRMA, which are additional Medicare premiums, because you get into higher amounts of income and that can cause you to have extra premiums. Now, that in itself is not a reason not to do a bigger amount, because the thing is, it may still be, even when you factor that in, it may still give you the best outcome. And so some people are like, well, I just never want to pay extra premium on Medicare. Well, there are cases where doing a big one in 1 year actually was the best move, even though you had that IRMA for 1 year. And by the way, it's 2 years later. People ask that all the time. Well, when do I have to pay that? What happens is, because our tax filing is due in April, the IRS and Medicare and all these people actually don't have all that information until really 2 years later almost, in order to determine if you have to pay extra premium. And so it's a little bit squirrely because it's not immediate, like a lot of things in life. your taxes are due immediately, those types of things. But IRMA is actually 2 years later. That's why it brought up the example of 63. If you do that at 63, then you're going to get, or any age after that, you're going to be on Medicare at 65 typically. And, that will have that effect. By the way, just a little caveat, and this is why this is complex and why you need your own personal advice. What if you're not going on Medicare at 65? Maybe you've got a spouse still employed that you're getting health insurance through. Now you've got a more complex situation, right? So there's a lot of things when you talk about all 3 lanes of the highway that come into effect. But I will say, Bill, what you brought up, typically spreading it out is what most people would end up being, will be the best strategy, doing some each year. And what you kind of want to think about a little bit is what are called like filling tax brackets or buckets. So like, I think most people listening realize that we have a graduated tax system, which means that we've got so much that we pay tax at a 10% rate, and then so much we pay at a 12%, and then 22, 24, and so on and so forth. And so when you start looking at scheduling it, then you're able to contain which brackets you're paying that tax in, and not getting into the higher ones, which maybe will allow long-term to pay a little less tax.
Yeah, it is complicated. And I don't mean that in a flippant sort of way. It actually is. You mentioned Medicare. And everybody, I'm sure, immediately had a reflexive action because everybody's like, oh, that's complicated.
Yeah.
But there are some other factors that weigh into this as well, right?
There are, definitely. So when you start looking at your overall retirement planning and how Roth conversions fit into that, so let's say we know we can take Social Security at 62, right? Now, we'll talk about that in another episode. Actually, the next one we do, we're going to talk more about that. But the reality is, like, if you're taking Social Security, that's going to bump up your tax rate. So that may leave less room for Roth conversions, right? The other thing that can happen is if you're taking Social Security, the amount of Social Security that's taxable will be affected by the rest of your income, right? Well, a Roth conversion is income. So it's like all of a sudden you start having, hey, if we have this lever pulled and we do this, there's additional consequences, right? So it's not always super simple. There can be net investment tax.
Well, the net investment tax is definitely for real, and so are state taxes, because every state has got a different tax rate and how they treat the income, right?
100%. So like, here's a planning scenario. We're in Michigan. Guess where a lot of people in Michigan, when they retire, go in the wintertime? Florida.
I'm going to guess it's not somewhere cold.
Yeah, right. Well, what do we know about Florida? Florida has no state income tax. Michigan does, although there's a caveat there because Michigan's made some allowances to allow certain amounts of like retirement income that aren't taxable. But let's just say, keeping it very simple, let's say you're in a state that has a state income tax and you're considering making a state that doesn't have state income tax your permanent residence, which again, that's complicated, just like a lot of these things. So it's not like you can just say, oh, I'm a Florida resident now, because, you actually have to be there. And there's definitely, qualifications for that. But that can greatly change the amount of tax liability for a Roth conversion. Because like a lot of states have 4 to 6% income taxes, right? Some higher. And so, yeah, that definitely plays into it. So you have to consider, if I'm doing a Roth conversion, it's not just federal tax. You also have to be aware of state when you're doing these things, to make sure that you're fully aware of what the current cost is to do that conversion, and then the long-term benefit that will exist after that's done.
Yes. So all of the above that we just discussed really points to the fact that probably doing this on your own is a really bad idea. Just generally speaking.
I would be very, very careful about pulling the lever or, pulling that action. If it was a very small conversion, say it was a couple $1,000s, yeah, that's probably not going to be life-changing. Although there are many things like IRMA, we talked about that additional Medicare tax, you're $1 over, you're paying it. You know what I mean? It's not like, now it does get higher amounts as you get into higher levels. But I would tell you that you definitely want to have what's called a CPAs can do it. We have software that can do it. But really what you're doing is you're saying, here's our income for this year. If I convert X number of dollars, where does it put me on all those tables? Where does it put me on the tax table? Where does it put me on the IRMA table? All these different things, so you can kind of look at it and make a better decision. But doing it on your own can be extremely risky because all these things that can occur that you had no idea. I'll give you a simple one too that people don't think about. When you do a conversion, you can withhold tax from the conversion, meaning the IRS, the custodian will send those tax dollars into the IRS on your behalf. Or you can say, no, I don't want to withhold tax and I'm going to pay it separately. Well, depending on when you do it and all those things, you could have tax penalties. If the taxes are not paid in a timely manner, right? And if they're not recorded properly. Here's the other little thing. If you are under 59 and a half and you do a Roth conversion and you withhold the tax, my understanding is, and you'd have to verify this with the CPA, but my understanding is the conversion part is fine, but the part that gets paid to the IRS is considered an early withdrawal. And so it's that amount of money that you pay to taxes is subject to a 10% early withdrawal penalty, generally speaking. And so all of a sudden you're like, oh, I didn't know that, right? And so there's so many things, Bill, that are involved in a Roth conversion that I think most people, if they haven't done them regularly, would not be aware of, if that makes sense.
No, it's really true. And just a really quick story. I have a friend who volunteers with a charitable organization helping people do their taxes. And I can't tell you, every year I get a story along these lines where he's sitting down and he's talking, but often, unfortunately, it's with a widow. And, there's been some money taken out of the account and taxes were never paid. And the individual has no idea. And he ends up having this really uncomfortable conversation because, he's there to help people, right?
Right.
It's this uncomfortable conversation where he's like, did they take taxes out of this and send it to the government on your behalf? And they're like, I don't know. And he goes, well, it doesn't look like they did. And you have a massive tax bill. And he's had that conversation more than once, and it seems to occur every single year. So I'm telling that story just to underline for people who are sitting out there listening to this conversation. For crying out loud, talk to your certified financial planner, or at the very least, talk to your CPA. And I realize not everybody's got an accountant that they work with, but it's complicated.
Yeah.
Right. It's just complicated. Adding up to what happens to the Roth? Let's say I converted everything. What happens to that Roth when I pass away? How is that treated?
Yeah, that's a really good question. I do want to comment really quickly what you brought up. So anytime there's money movement, you should get advice. We had one just recently I want to mention because it was really, and we stopped a kind of a catastrophic distribution. So, people can roll over funds, meaning there's a lot of flexibility when you have your own retirement account. They'll even give you, if you make a mistake, you have 60 days where you can kind of roll it back in. And that's complicated, and there's a lot of rules around that. But if you get an inherited account, the rules aren't so friendly. So oftentimes, once that money's out of that inherited account directly to you, it's done. You can't get it back in. And we almost had a substantial distribution made by a pretty big financial firm that you'd scratch your head and say, oh my goodness, how did they make that mistake? We luckily caught it because when that money came out, it would have been a taxable event and they would have had no option. And, it's like you always, when you're moving money, I'm glad you brought that story up. You need to talk to people because it's so important that you understand, because there are certain things that are irrevocable. You cannot change, and so it's really good. But getting to your question about, how this stuff affects, when someone passes away, this is so important. And I mentioned earlier that Roth conversions are really, they're really a tax play and an estate planning play to a great degree. And the reason I say that is that so many people that have listened to the show may know or may not know, typically when you inherit a pre-tax IRA, so not a Roth, but an IRA that has not been converted, the taxes haven't been paid, typically you're going to have 10 years to take that out. Now, if you're a spouse, those rules are different. It would become yours. But I think we're kind of focusing on when the family, mom and dad have passed away and this is moving on to the next generation. So we're talking that scenario right now. So when that's the case, you have this great, so let's say that pre-tax account, you get that bucket of money, no taxes have been paid. You have to have it out within 10 years. And hopefully it's still growing, right? So the assets are still growing in that account. And so like you have a pretty big tax liability, right? And depending on how much other income you earn, we talked about our tax brackets. As that money comes out, that might be at a really high tax bracket for you as the child inheriting that account, depending on what phase of life you're in. Now, if you look at a Roth account, the great thing is you still have the 10 years, but it's tax free. And so you actually have kind of an incentive in some regards to like, let it stay there as long as you can because it continues to grow tax free. And when it comes out, it's tax free. So it has no effect on your actual rate. And there's different strategies you can use on that too, to your long-term benefit when you have that big bucket of tax-free money, because you've got kind of a no rules account, I like to call it, where like, man, we can take some extra money out, we can leave it, and there's really no impact on our tax return, right? And so it can make a massive, massive difference on, basically the kid's tax return long-term.
Yeah. Wow, that is fascinating. So it's not income. It's income, but it's not income.
Yeah.
It's that mythical unicorn, right?
It's amazing. And one other thing we didn't know, Roth accounts don't have required distributions like a pre-tax account. So even for your own life, forget the kids for a minute. We have a big complaint because a lot of people, as they get older, and if they've done the right planning, they don't have a huge need for retirement distributions. And nothing gets someone madder than having to take money out when they're like, I don't even need that. Why do I have to take it out?
Oh, yeah. I don't even need this, for crying out loud. Yeah, well, you have to take. It's because, Dan, the government's going to get what the government thinks it's owed. So
that's right. That's right. And so with the Roth, though, you don't have to do that. And so that's another benefit that people really like when you do a Roth conversion. It's like, okay, now I have more control over that money. Not alone, it's growing tax-free, which is awesome, but I also have more control, which is a secondary benefit.
So it's beautiful. It leads me out to, pretty much our last question as we begin to wrap things up here. If someone is sitting on a large traditional IRA, I'm wondering if this might be the year to convert or if they should do it. What's the first thing you would tell them to do?
Yeah, I mean, first and foremost, it is really important to look at this stuff as early as possible. We actually have clients in their 40s that are doing Roth conversions because they've been good savers. And like, if you look at the trajectory of that pre-tax money, because, they're in their 40s. Like if they live till 90, that's a long time. That's a lot of compounding and a lot of new taxes created every time that money compounds. So like the first thing I would say is don't think it's just a certain age. Like it can be any age, but if you have a larger IRA, you really need to sit down and you need to do some analysis and figure out, okay, where is this going? Are there options to reduce my taxes, or am I just going to let this thing control me, right? Because planning's about taking control more than anything else. It's like you have all these resources you worked really hard for and you saved and you did all the right things. Well, you were in control of that, but sometimes people lose control a little bit when it comes to this tax planning side of things. And so it's really taking control and making sure you understand that. And one of the things that we do for listeners, which I think is really important, we will do a 30-minute strategy call. So it's very specific. This is not a sales call. This is not selling our firm. This is literally, let's take 30 minutes. Let's look at your resources, how they're positioned, and we can kind of tell you really quickly if you're likely to have a tax issue moving forward. And if these are things that you need to take some additional steps to investigate, and whether that's with us or anybody else, at least then you'll know, hey, I spent 30 minutes. I've got some feedback on my situation and I know I need to dig deeper, and that's really the key is like find out. It's kind of like a physical, you know what I mean? You go in, it's like, no one really loves it, but the reality is like the physicals to find out, hey, is there anything I need to be aware of that I need to look a little further into?
Yeah. Well, it's interesting. So how do people reach out to you for this complimentary 30-minute conversation?
Yeah, I always recommend the easiest thing. You can always call our office. I mean, we've got the Laurel up front she's a sweetheart. Everybody likes talking to her. You probably won't even want to talk to me after you talk to her. You'd be like, no, she's fine. But she can get some time on the calendar to do that. We can do it honestly, like in person in the office. We can do a Zoom, whatever's easiest. Obviously, a lot of people just like to do a Zoom because it's simple and doesn't take as much time out of the day.
Quick and fast. You don't have to go anywhere.
Yeah. And you can just go to our website too. And there's a contact us button. And you just put in the comments, I want to schedule, my 30-minute strategy call. And Laura will get that message and she'll basically reach out and get that scheduled for you. Many times she can just send an email with a link and you can pick a time that works best for you. But yeah, it's a good use of time. We do that really as a service. Like I say, we don't charge anything for it. We're not trying to sell you anything. It's literally just to help you get, more informed about your own situation.
What's the website again, Dan?
It's averywealth.com. And I always say it's like Avery, like the labels, because everybody remembers Avery labels growing up. So
yep. Yeah.
So just averywealth.com. And I encourage you, our website, and I'm actually I'm pretty proud of it, honestly, because.
Well, you can be proud of it, Dan. That's okay.
There's a lot of really, really great information on our website. You can find the normal stuff like about us and our, history and who's on our team and all those things. But there's so many good, like the insights section. It's kind of like an ongoing blog. And it has so many good articles on tax planning and retirement planning and investment planning, business planning. And so I highly recommend just get out there and I think you'll be pleasantly surprised at how much good information's there. And we act in the fiduciary capacity. So one of the things that's really great, our website is going to provide you education. You know what I mean? It's not out there providing, trying to sell you stuff.
This isn't a transactional relationship.
100%, 100%.
Very good. So listeners, do in fact reach out to Dan if this conversation sparks some interest in your curiosity a little bit. And the other thing you can do is if you're not a subscriber, if you just came across this because somebody recommended it to you or you were just doing a search for this topic, hit the follow button. Beauty of that is when you're following or you are a subscriber to this podcast, you're notified when new episodes are released and you can give those a listen. And I would ask if you like the podcast, do maybe what somebody did for you. Tell somebody about it so that they can tune in and give it a listen as well. Until next time, I'm Bill Tucker. On behalf of Dan and everybody at Avery Wealth Management, thanks for taking the time to listen today. And come on, we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.